Hello and welcome to the Babalian Money Show. Today, we're diving into one of the biggest debates in the investing world: active stock picking versus passive investing. Which one is right for you? By the end of this video, you'll have a much clearer picture. But before we get started, a quick disclaimer. I am not a financial advisor, and this video is for educational and entertainment purposes only. Always do your own research or consult with a professional before making any investment decisions. All right, let's set the stage. Imagine two investors, Alex and Ben. Alex is a stock picker. He spends hours every week researching companies, reading financial reports, listening to earnings calls, and trying to find those hidden gems, the next big thing that could multiply his investment. He believes he can beat the market by making smart, informed choices about individual stocks. He's looking for that thrill, that satisfaction of knowing he outsmarted everyone else. This is active investing. Then there's Ben. Ben takes a different approach. He prefers passive investing. Instead of trying to pick individual winners, he buys a little bit of everything. He invests in index funds or ETFs, like one that tracks the S&P 500, which holds stocks from the 500 largest companies in the U.S. Ben's philosophy is simple. He doesn't need to beat the market. He just wants to be the market. He believes that over the long term, the overall market will go up, and he's happy to just ride that wave. So, what are the pros and cons of each strategy? Let's start with Alex and active stock picking. The biggest, most exciting advantage is the potential for massive returns. If you correctly identify a company like Amazon or Tesla in its early days, your returns could be astronomical, far exceeding anything a passive fund could offer. It's the financial equivalent of hitting a home run. This potential for huge gains is what draws many people to stock picking. Plus, it can be incredibly engaging and educational. You learn so much about different industries, business models, and economic trends. It forces you to be an informed participant in the economy, not just a bystander. For some, this intellectual challenge is a reward in itself. You also have complete control over your portfolio. If you don't want to invest in certain industries for ethical reasons, you can easily avoid them. You are the captain of your own ship. However, the cons are significant. First and foremost, it's incredibly difficult to consistently beat the market. Study after study has shown that the vast majority of professional fund managers, people who do this for a living, with entire teams of analysts, fail to outperform simple index funds over the long run. If the pros can't do it, what makes us think we can? It requires a huge time commitment. We're talking hours and hours of research. If you have a full-time job and a family, finding that time can be a real struggle. And let's not forget the emotional roller coaster. When you own individual stocks, you feel every up and down. A bad earnings report can wipe out a chunk of your portfolio overnight. This can lead to stress, anxiety, and making impulsive decisions, like selling at the bottom out of fear or buying at the top due to FOMO, the fear of missing out. Transaction costs can also add up. Buying and selling individual stocks frequently can rack up brokerage fees and taxes, eating into your potential profits. Now, let's turn our attention to Ben and passive investing. The main advantage here is its simplicity and effectiveness. You don't need to be a financial genius. You can set up automatic investments into a low-cost index fund and pretty much forget about it. This set it and forget it approach is perfect for people who want to build wealth without spending all their free time analyzing stock charts. It's time efficient and stress-free. Another huge benefit is diversification. When you buy an S&P 500 index fund, you instantly own a small piece of 500 different companies. If one or two of those companies have a bad year, it has a very small impact on your overall portfolio. This built-in diversification dramatically reduces your risk compared to holding just a handful of individual stocks. Your eggs aren't all in one basket. They're in 500 baskets. And it's incredibly low cost. Index funds and ETFs typically have very low expense ratios. The fees you pay to the fund manager, we're talking fractions of a percent. This means more of your money stays invested and working for you, which makes a massive difference over decades thanks to the power of compounding. Historically, this strategy has delivered solid, reliable returns. The average annual return of the S&P 500 over the long term is around 10%. While not as exciting as a 1,000% gain on a single stock, a steady 10% will build substantial wealth over time. So, what's the downside to being passive? Well, the main one is that you'll never beat the market. By definition, an index fund is designed to deliver the market's average return, minus a tiny fee. You'll never have that exhilarating feeling of picking a 10-bagger. Your returns will be, for lack of a better word, average. For some, that's just not exciting enough. You also give up control. When you buy an index fund, you own all the companies in that index, the good, the bad, and the ugly. You can't exclude a company or industry you don't like. You're just along for the ride. During a market crash, your entire portfolio will go down with the market. There's no hiding. You have to have the discipline to stay invested and trust that the market will eventually recover, which it historically always has. So, which path is right for you? Alex's active approach or Ben's passive one? The truth is, it depends entirely on your personality, your goals, and how much time and effort you're willing to put in. If you are passionate about business, love doing research, have a high risk tolerance, and are prepared for the emotional ups and downs, then active stock picking might be a thrilling and potentially rewarding journey for you. You have to be honest with yourself. Do you truly have the time and the emotional fortitude for this? On the other hand, if you want a proven, low-stress, and time-efficient way to build long-term wealth, and you're happy with achieving market average returns, then passive investing is almost certainly the better choice. For the vast majority of people, this is the winning strategy. It allows you to focus on your career, your family, and your hobbies, while your money works quietly and effectively in the background. But here's a thought. It doesn't have to be an all-or-nothing choice. You can do both. This is often called a core and satellite approach. The core of your portfolio, say 80 to 90%, could be in low-cost diversified index funds. This is your stable, long-term wealth-building engine. Then, with the remaining 10 to 20% your satellite portion, you can have some fun. Use that money to pick a few individual stocks you're really excited about. This hybrid model gives you the best of both worlds. You get the stability and proven results of passive investing, ensuring your financial future is on solid ground. But you also get to satisfy that itch to be an active investor, to research companies, and to chase those potentially higher returns, but with a much smaller, manageable amount of your money. If your stock picks do great, fantastic. If they don't, it won't derail your entire retirement plan because the core of your portfolio is safe and sound. Ultimately, the most important thing is to start investing. Don't let the debate between active and passive lead to paralysis. The biggest mistake you can make is doing nothing at all. Whether you choose to be an Alex, a Ben, or a combination of both, the key is to get your money working for you as early as possible. Time is your greatest asset in investing. So, take some time to think about your own financial personality. Are you an active adventurer or a passive strategist? Or maybe a little of both? Let me know in the comments below which approach you lean towards and why. I'd love to hear your thoughts. Thank you so much for watching the Babalian Money Show. If you found this video helpful and want to learn more about managing your money and building wealth, please hit that like button, and most importantly, subscribe to the channel. It really helps us grow and create more content for you. We'll see you in the next video.